RBI just quietly injected 1 lakh crore into the financial system. No drama, no breaking news chaos, just one silent move. But whenever central banks inject liquidity, markets never behave normally afterward. So the real question is this the beginning of a market boom or a warning that something is breaking underneath? So what is open market operation in simple words? Open market operation means RBI buys government bonds from the market, banks get fresh cash in return, liquidity in the system increases instantly. So in simple language, RBI just switched on a 1 lakh crore money tap. So why RBI did this now? RBI never injects liquidity randomly. They do it when banking liquidity tightens, bond yields rise too fast, credit growth risks slowing, financial strengths start quietly building. This means the economy needs oxygen. This is not celebration, this is stabilization. So, what will be the immediate market impact? Like, what will move first? First of all, banking stocks. Cheap money will lead to higher loan growth. Now, the net interest margins will stabilize and PSU banks will benefit first. Secondly, mid caps and small caps. The liquidity flows downward, risk appetite will increase, high beta stocks outperform on a temporary basis. And coming to bond yields, yields soften, borrowing becomes cheaper, corporate financing improves. So this is why open market operation events often trigger short-term rallies even in weak markets. But here is the hidden danger. Every liquidity boost has a dark side. If growth is not matching liquidity, valuations are already stretched, retail is already euphoric, then money does not create wealth, it only creates bubbles. The biggest crashes in history comes after excess liquidity plus excess confidence. So, what does history say about open market operations and market moves? The past pattern suggests that liquidity injection leads to rally, rally leads to retail participation, that so retail participation explodes, valuation stretch, RBI tightens again later, and the market corrects violently. So liquidity gives you the speed, it does not give you safety. Now, what a smart investor can do? So they should ideally avoid panic buying. Ideally, the focus should be on banking, financials, capital goods, quality mid caps. And they can avoid high debt companies, loss making momentum stocks, overheated IPO plays. Also, this is not a recommendation. Please consult your financial advisor. I am not a registered investment advisor. Your goal can be not to chase liquidity, your goal should be to ride it without getting trapped by it. So, what is the final verdict? RBI's 1 lakh crore open market operation is a short term market booster, a long term risk if abused by retail speculation. So, liquidity is a tool, it is not a guarantee. Now, if you want to understand what RBI actions really mean, how smart money positions before retail reacts, and how to survive these macro cycles, subscribe to Insider Monk. Here we don't chase news, we decode it for profit and survival. Thank you.